Hello and welcome. We're in conversation with Saugata Bhattacharya, independent economist, who's going to help us unpack the GDP data that came out yesterday. GDP growth came in at 7.6%, and while that's a tad bit lower than the figures we saw in Q1, it's substantially higher than expectations. So we're going to try and look beyond the obvious and try and unpack some trends with Mr. Shogata's help. So thank you so very much for taking time out for us today.
My pleasure, as always.
So, to begin with, what did you take away from yesterday's figures?
So, one, it was definitely a pleasant surprise. We were initially at the higher end of the forecast scale. The consensus was about 6.8. We were at about 7.1. But even this, the actual growth outpaced us by at least 50 basis points. So it was a pleasant surprise. Now, where did we go wrong is the question that we are asking. So one part is there's definitely some base effects of various higher and lower growth in Q2 of last year, FY23. But the momentum of growth is definitely much higher than we had expected. So that is given. The stars of the growth rate one was manufacturing and the second was construction. So these two outperformance, 13.9% and 13% for both. So my hypothesis is for manufacturing, one is, I think it was a buildup of inventories preparing for the festive season, particularly in the month of September, that we have seen in the IIP numbers as well. Second was manufacturing, the way GDP is calculated. They also look at the financial results of manufacturing companies, services companies, etc. That goes into the GDP. Because of lower input costs and because of higher profits, which is a component of the value added of GDP, that also pushed up manufacturing. And this is something that we have seen even in the import data that we have, the buildup of inventories. The inventory buildup, there were a lot of imports of electronic items, intermediates, etc. I'm sure that was preparing for the festive season sales. Together with this, so that's the broad area. The second part is consumption still remained weak, 3.1%. This entire higher growth was driven very, very largely by investment, by capex, which is a very good sign. Now, we don't really know how much of this is private sector capex. My own sense is a large part of the investments was actually government investment, which we know has been very, very high, both from the center as well as the states. So that also is another feature of this growth. So I think that's the whole part. The agricultural part was a little bit of a disappointment, but we had expected that. Because of the problems with the disruptions, the lower than the very bad spatial and temporal distribution of the monsoons, etc. We had actually forecast a negative agricultural growth, but that is one area I think that remains a concern going forward into the rest of the year.
Okay, so taking that forward, you've mentioned that manufacturing did surprise on the upside. There have been a couple of reports that also suggest that there has been a little bit of an exaggeration in the figures we saw for manufacturing yesterday because of the single deflation methodology and the fact that WPI was negative almost through the quarter. So, I mean, what's your reading on that? Do you think we will see a little bit of a downward revision maybe going forward?
Not really. I mean, it is perfectly possible that there's a small revision downwards, but it is exactly this negative GDP, there's negative deflator, the WPI, which has been the cause of this high manufacturing growth. Because remember that GDP as a whole, typically it's deflated about 40% by the WPI, 30% by the CPI, and the rest are volume indicators. Manufacturing is almost entirely WPI deflated. Now, WPI in this quarter was negative. So if you actually, the higher the deflator, if WPI had been higher, because remember that we are starting from nominal growth, the financial results of corporates, and that is deflated by the WPI deflator. So if the WPI number had been higher, your real manufacturing growth would have been lower. It's precisely because of this negative WPI that you have actually inflated the real manufacturing growth. And on top of that, the numbers that you've seen, even from the financial results of about 1,600 odd manufacturing companies that we have seen in Q2, even that showed that probably, although net sales were relatively muted, precisely because of the effect of the lower prices, your profits, because of the lower input costs and whatever other deflators, other factors there were, profit growth for the manufacturing segments was actually pretty high, more than 16%. So the two together, the higher volume indicator coming in from the IIP numbers, the core sector numbers, etc., and the higher profit growth that we've seen from the corporate results of the manufacturing sector, these are the two segments. These are the two factors, the inputs that actually contributed to the 13.9% manufacturing growth. So I don't think it is too much of an exaggeration. Of course, you have to be very clear that there is also a base effect of manufacturing, because manufacturing in the same quarter of the last year was -4%. So that did give a boost. But together with this, I think the momentum of the manufacturing segment in this quarter remained fairly robust.
Got it. Could you also explain to our viewers, the single deflation methodology? And the reason I'm saying that is the past few quarters, that's sort of been something that economists have debated about, whether that is even the most accurate measure that can be used. So what's your take on that entire discussion?
So, I mean, you summarized this very well. Let me try to add to your summary. I think you've brought the issue out very well. The single and the double deflator methods we use the single deflator. So there is only one WPI which deflates the entire output. The debate in national accounting methodology, etc., is whether there should be a double deflator, in the sense that the total profits very broadly are output minus input. Whatever you sell minus your raw material and other costs, right? I mean, that's the normal, the definition of profit. A school of thought says that the double deflator method means the output number should be deflated by probably, say, the CPI, and the input deflator should be deflated by the WPI. That's the core area. There is a point to that. I mean, maybe if you use the double deflator method, there might be a possibility that this number would come down. But remember that even in the final output, there are a whole bunch of input related, intermediate related. It's not the final FMCG and consumer durables. These are the only two segments in the consumer non-durables and the consumer durables that are consumer facing, on which the CPI would be more relevant and appropriate. The other segments, capital goods, intermediate goods, basic goods, primary goods, all of that, the WPI would still be a predominant deflator. The deflator that would be used for those segments would still be the WPI. So I don't think there is a terrible distortion using the single deflator method.
Got it. All right. You've also touched upon consumption. There does seem to be a little bit of concern, especially given that yesterday's data did seem to reinforce that there is a difference between urban and rural consumption trends. For instance, agri-GVA, not entirely unexpected, did see a little bit of a slowdown because of the impact of the southwest monsoons, the volatility that we saw. So far, even rural high-frequency indicators have continued to show very mixed trends. So going forward, how are you looking at this?
So it is. You're absolutely right that the rural segment, and remember that the rural segment in agriculture is only half of the rural segment. There is a non-agricultural, non-farm segment, which is probably another half of the rural economy. You're absolutely right that the lower farm GDP, agricultural GDP, was potentially a cause for the low consumption. There is no doubt about that, particularly in Q2, in the last quarter that we have seen. Rural demand remained relatively weak from whatever numbers. I mean, tractor sales, two-wheeler sales, etc., have not been very strong. So it is completely true that low 3.1% consumption growth numbers, private consumption growth numbers, is probably largely led by a slow rural economy. Going forward, I think things are looking a little better. In Q3, the numbers, the two-wheeler sales numbers, etc., that we have seen, seems to suggest that there is a slight, that the rural economy demand has bottomed out. maybe rising gradually, maybe improving gradually. I do hope that this actually rises in the second half, Q3 and Q4. Signs are the early signals are a little disappointing. Rabi sowing, reservoir levels, etc., are relatively lower than what we have seen in the past. So we do need to think a little bit. But I'm positive that from the government side, the government is spending a lot. The capex spends in the rural economy on roads, on housing, on irrigation projects, etc., both from the center as from the states, look to be a little better, a whole lot better. So maybe that will provide some additional income, additional demand from the rural segment. But this is one area, you're completely right, bears watching, bears monitoring very closely.
Okay, so nominal GDP has come in at 9.1%. How are you looking at that figure? The budget did factor in a slightly higher figure, right, for the full year?
Absolutely. The budget number for the nominal growth that was assumed in the FY24 budget was about 10.5%, 10.5 to 11%. Yeah, so the number that we have seen is 9.1. And the 9.1, as we discussed earlier, is precisely because of the negative WPI that we have seen so far. Going forward, we do expect the WPI number to get into the positive territory. That is likely to happen. So that will mitigate a little bit of the lower numbers that we have seen. From a technical side, the lower nominal growth will probably offset a little bit of the earlier real growth. Remember, the earlier the CPI number is 5.4%. Real GDP growth was assumed to be 6.5%. So now real growth in this year, we are probably still fingers crossed. Let's see what happens in the next 2 quarters. We will probably see a real GDP growth in FY24, round about 6.8, if you're lucky, 6.9%. So that will offset to a certain extent about the 1.5% lower, or maybe 1% lower nominal the inflation growth that we have seen. So we should be close to about 10% nominal growth as we go into the second half. But that is also something that will technically, arithmetically, put a little bit of a pressure on the fiscal deficit numbers. But I expect that the fiscal numbers will be driven by high tax growth, etc. It will be very, very manageable, and the government will stick to the 5.9% fiscal deficit target.
Okay, all right. So one last question. We've seen a lot of tugs and pulls. On one side, GDP growth for Q2 has surprised very much on the upside. That's made most economists revise their forecast for the full year. However, headwinds to growth remain. We've been talking about the impact of tightening monetary conditions, weak external outlook, slowing consumption, maybe some concerns on the rural front. All of that, net, what's the impact likely to be going forward?
So I think the main risks to India's growth going forward are largely from the external side. Agriculture remains a problem. I completely agree with you. But other than that, I think the risks that might emanate are largely from the external side. We do expect the good thing is that I think the rate hike cycles in the G10 central banks, the developed markets, are mostly done. Markets are now actually pricing in a rate cuts somewhere in the middle of 2024. So that is done. So financial conditions probably will not tighten too much. The exception is if there is a larger and faster than expected slowdown in the developed markets, that might create volatility in financial markets, and which is bad because that will lead to pressure on the Indian rupee and will further complicate the RBI's monetary policy actions, etc. So we need to be very careful in keeping track of what happens in the external sector. My own sense is, in the worst possible case, the US will probably get into a slight, shallow, short recession, maybe not very much. US economy still remains very, very strong, but the external sector, more than anything else, I think needs to bear monitoring.
Okay, but yesterday's figures don't change much for the RBI as we're looking at the next Monetary Policy Committee meet on the 8th of December. Does it?
Not at all. Not at all. Because remember, RBI is concerned on whether this high growth number feeds into core inflation. That gets mitigated because of the low personal consumption, private consumption expenditure, 3.1. That shows that demand is still not as robust. Whatever growth we have seen is largely one from government spends, two from investment. Investment spends are very good because this is actually building up the productive capacity of the economy. I mean, that will at some point in time increase efficiencies in the system and probably be the fundamental of falling inflation.
Got it. This was most insightful. Thank you so much for taking time out for us today.
My pleasure. Thank you so much.